Welcome back, market grinders, to another episode of Market Grinding. Today, I want to speak with you guys about IPOs. You probably heard this term a million times. And what an IPO is, it's a initial public offering. So, for instance, if a private company, company XYZ, which was a LLC, sole proprietorship, just a privately owned company, wants to raise money, sometimes they'll go public. So what they'll do, they'll sell off shares of their company to investors for an amount of money, which brings money into the business, which allows them to make bigger investments to expand their business, and it also gives shareholders equity in the company. So as that company does well, shareholders do well. Another thing that when companies go public, when they want to get out of a company. So say for instance, if I built my company up from a $1 million per year company to a $20 million per year company, I may want to step down and still participate in the equity in this company, but not fully own this company. So I would issue an IPO, an initial public offering, sell 51% of my company to the public. They'll form a board. They'll continue to run that company, and I own 49% shareholder stake in the company. So I still have a huge amount in the company, but I'm not responsible for running the company anymore. But I'm still benefiting off the company as it increases in value. Plus, I've taken some of the risk out because I sold the shares, so I brought in money that I can, go and make other investments in other companies or do other things with. So if the company doesn't do well, I can, at the end of the day, take my money and run. So as new investors, what we should be thinking about when we hear the word IPO is how can we capitalize off of an IPO? So a couple quick strategies on capitalizing off of IPO. First of all, IPOs, just like any other investment, they you have to assume a certain amount of risk. So always do your research before investing in an IPO and know what that company was doing before they went public, right? So understand, is this a good company or a bad company? Just thinking about Facebook when they IPO'd, normally what companies do when they IPO, they sell shares to investors that the public normally does not have access to. So when the company goes on the market and the company officially IPOs, now they're selling additional shares to the public. So depending on how the IPO contract is written, a lot of times there's a clause that says that initial investors can't sell their shares for a week, for a month, for a year. Because what happens is, if you sell me shares of your company on Monday, and then I pay you $10 per share on Monday, then you go public and you sell shares to the public on Wednesday, and the price runs up to $20 a share. I bought mine at 10, so now I've doubled my money, right? So I can jump in and sell out. So what will happen there is, if there's a million people just like me that bought shares before the company went public, we're gonna crash the stock. So the new guys that are just getting in, they're gonna be left holding the bag. So a lot of times there are some clauses in there that prevent investors from selling their stock as soon as the IPO is announced. So that's one thing to always look into. How long do the shareholders have to hold their shares before, or the initial investors have to hold their shares before they can sell off? Because you can end up getting into an investment where you lose money instantly. Also, believe in the company. So if you do get in that situation and the stock drops, you do have time to recover. I think that happened with Facebook with their initial public offering. They had sold shares to investors early, like all IPOs do. 99% of all IPOs do. And when they hit the market, those guys jumped in and sold off. I think within like the first week. So Facebook went up and then it crashed back down, and then it went on a steady increase up to where it is today because it is a good company. So IPOs aren't a get rich quick play, but normally most IPOs, when they debut, they do increase in value that day or within that week. So it is, what some people call an easy money grab, where you can jump in when it hits the market that morning, buy your 100, 200 shares, ride it up to the volume starts to slow off, and then sell off, and then take your money and go on to the next play. That's how a lot of traders kind of play the IPOs. But if you're an investor, probably the best way to play it is, wait until either if you can't get in early and ride it out, wait till it goes up, then drops back down. Then you want to, get in. Then if you're going to be a long-term investor, that way you probably get it at the best price. Most recently, just for the guys on the channel from North Carolina, one of our Krispy Kreme donuts. That's a company. I think they were based out of Winston. If you guys remember, they were on the stock market years ago, right? They went back to a private company, so you couldn't buy stock in Krispy Kreme for a while. But I think Thursday they just released their new IPO. And if you guys want to do the research, the ticker symbol is DNUT. So DNUT is Krispy Kreme's ticker symbol. So actually Thursday was the day that they IPO'd. They hit the market at around $16.30, and then I think they went as high as $21. So a nice run up on Krispy Kreme Thursday, and I think as of Friday at close, they were around $19 per share. But I know we got a lot of people that love to see those hot now signs on that Krispy Kreme. So now not only can you own a box of donuts, you can actually own the company that makes the donuts. So that's a great opportunity for the guys. If you love Krispy Kreme, invest in it. DNUT, again, do your research, watch it for a while, try to get in at the lowest price possible. Right now it's at, like I said, $21. So it IPO'd at 16. So I'll watch it for a week, and I'll look for around a $14 to $17 entry point, which may give you guys a good entry price on Krispy Kreme. And look for a long-term hold. Look to build out your shares, from 100 to 500 shares, and hold it long term, or buy it for your kids or your grandkids and hang on to it. I think that's going to be a good company here in the future. But didn't want to keep you guys long. This is a holiday weekend. The markets will be closed Monday, so no trading on Monday, but we'll get back at it on Tuesday. I'm looking to put out probably 2 more videos for you guys this week, going over some more terminology in the market and a couple more trades that I'm getting into next week. But we'll talk about that next week. I know a lot of you guys are grilling out, having a great time for the 4th, so I won't make this video too long. Just want to talk about IPOs and Krispy Kreme. So go out and grab you some Krispy Kreme donuts. Go out and grab you some Krispy Kreme stock. So thank you guys for joining me. Let's continue to build wealth and keep grinding.
Around for the company. Went public back in 2000, but years later, the stock had tumbled following an accounting scandal and underwent a restructuring. Then in 2016, it was taken private by JAB through a $1.35 billion acquisition. Today, it is listing on the NASDAQ under the ticker DNUT after its IPO priced at $17 per share. Should say it's below the expected range. We want to talk about that as well. Joining us right now, first on CNBC from its Times Square location, Krispy Kreme CEO Mike Tattersfield. Mike, it's great to see you this morning. I've got the donuts here. We're eating a lot of them, so thank you for that. but it is a big day for you.
No.
Let's talk about the offering, and I want to talk about the future of the business. Go ahead. What were you going to say?
Yeah, no, it's a great day for us. It's an 84-year-old brand, and as you think about it, we're always trying to build the most loved sweet treat brand in the world. The transformation that this company's done in the last 5 years has been incredible. We've worked on our brand, we've worked on the culture, and we actually changed the business model. And we really created an omni-channel approach where we leverage these amazing donut shops like the one I'm in today, and then really get fresh donuts to where the customers are. So that's what we've been doing, and it's been an incredible ride so far.
Mike, I want to talk to you about the valuation because it did come in lower than expected in terms of where you thought you were going to be with investors even just days ago. What happened?
Listen, 5 years ago, we came in and bought the business for a little north of $1 billion. The value today is 2.5 times the value of when we purchased the company. So when we talked to investors and they saw that we doubled the revenue and doubled the EBITDA during this time frame, they really loved the traction that we're doing and the journey ahead, both in the United States market as well as global, because it's about this shared occasions. We sell in dozens, and we really drive occasions. We do that exceptionally well, and just deliver donuts and build it in gifting. And Andrew, I know you got a lot of dozens in your house right now, but you can share them as well.
Trust me, I'm going to have to gift a lot of these away. I can't eat all of this. But the question I ask in terms of expansion, you've been growing fast. The question is, are you growing at the expense of profit in terms of net profit?
So if you think about it, when we doubled the EBITDA, doubled the revenue and doubled the EBITDA, one of the things that we did in the transformation on the brand, we used to be a franchisee in the U.S. We bought back the system. So we have a controlled system where 85% of the system today in the U.S. is where we make our donuts. We then use our 400 donut shops, our theater shops. There's only 400 in the world. I love that, right? So the aspect of keeping the donuts special. But instead of opening up random donuts shops everywhere, we actually use an omni-channel approach. So we leverage these theater shops, which are amazing. I'm sure you've been in it when you see our hot light or our glaze line. And then follow where the customer's at. So take the journey, whether it's a fresh shop in New York City where we actually produce here and then send donuts to them, an e-commerce model where the consumer can order gifting or delivery, as well as in the wholesale space where we now deliver fresh donuts to select grocers or select convenience shops around the globe.
So, Mike, I don't know if this is a hard question or not, and I don't know what to do about it. But in a day and age where people are supposed to be moving away from carbs, right? Carbs and sugar. This is a 190-calorie treat, but you typically eat more than one. What do you think, just trend-wise, in terms of the movement away, frankly, from treats and what that does, or what that may mean or not to your business long-term?
So I love the indulgent space, and Krispy Kreme works incredibly well right within it. Our customers engage us about 2.5 times a year, and they engage us on occasions. So as you're having those dozens, it's about shared dozens that we focus on celebration gifting. And the customer is always looking for a sweet treat. And I know the world's not a really good place and a bland place if you don't have a sweet treat. So it's really about the opportunity of how do we build on that. We're really proud of what we do. And if you can get on occasions, and you think about gifting, Mother's Day that just came by. If you can have a little kid basically send their mom a dozen donuts, we compete against flowers, right? It's a whole different occasion. It's celebrations. It's an amazing part of what this brand does. Again, those theater shops that are so special, right. But doing fresh donuts everywhere. I'll give you one little snapshot. Last year, we sold 1.3 billion donuts. I love that. It's great.